Hey there, and welcome back to Mortgage Breakdown. If you're buying a home with less than 20% down, you've probably heard the term PMI, but you're probably also wondering what it is, how it affects your mortgage, and most importantly, if you can avoid it. That's exactly what we're breaking down today. PMI stands for Private Mortgage Insurance. It's an insurance policy that helps protect the lender, not you, in case you stop making payments. It was introduced after the 2008 real estate crash when lenders lost a ton of money due to foreclosures and short sales. If you remember those days, buyers were able to purchase homes with little to no money down, and in many cases, they didn't even have to verify their income. Banks were practically giving away homes. Unsurprisingly, banks took a big risk that didn't pay off. So if you're buying with less than 20% down, the lender is taking on more risk. PMI is how they reduce that risk and protect themselves if default rates go up. For the borrower, PMI doesn't provide a direct benefit. It's simply the cost of being able to buy a home sooner without saving a huge down payment. PMI is usually required on conventional loans if you put down less than 20%. For example, on a $300,000 home, if you put 10% down or $30,000, you'd still be financing $270,000. Because that's more than 80% of the home's value, you'd be required to pay PMI. FHA loans also require mortgage insurance, but it works differently. FHA has both upfront insurance premium and an annual premium that's built into your monthly payment. And in many cases, it lasts for the life of the loan unless you refinance. PMI can vary depending on your loan amount, credit score, and down payment. On average, it runs between 0.5% and 1.5% of your loan amount per year. Let's put that into real numbers. On a $250,000 loan, PMI could cost anywhere from $100 to $300 a month. That might not sound huge, but over 5 to 7 years, it adds up to thousands of dollars. Now let's look at a larger loan. Say you're buying a $400,000 home and you put only 10% down. That means you're borrowing $360,000. If PMI is 1% of the loan amount per year, that's about $3,600 annually, or around $300 a month. Keep in mind, because we're talking FHA, this is $300 you'll pay every month until you pay off the loan or sell the house. So if you own your home for 6 years before you decide to sell it, you'll have paid over $21,000 just in insurance, money that doesn't build equity in your home. That's why understanding PMI is so important. The good news is PMI on conventional loans doesn't last forever. Here are 3 ways it can go away. The first way is through automatic cancellation. Once you reach 22% equity based on your original loan balance, you'll no longer need to pay PMI. Here's an example. Let's say you bought a $500,000 home and put 10% down. That's $50,000. Your loan balance starts at $450,000. To get rid of PMI automatically, you need to reach 22% equity based on the original value of the home, which means your loan balance needs to fall below $390,000. Depending on your interest rate, that usually takes about 8 to 9 years of regular payments. So without you doing anything extra, your lender is required by law to cancel PMI once you've paid the loan down enough. The key is that this cancellation is based on the original home value, not what your home is worth today. That's where a lot of first-time buyers get confused. So even though your equity might be higher in today's market, the bank uses the original purchase price to calculate the automatic removal point. This is why some borrowers request removal early with an appraisal, which we'll talk about next. The second way to remove PMI is to request it. Unlike automatic cancellation at 22% equity, this method allows you to be proactive once you've reached 20% equity. Here's how it works. Once your loan balance falls below 80% of your home's original value, you can contact your lender in writing and ask them to cancel PMI. Most lenders will require a few things, including a written request for cancellation, proof that your payment history is solid, meaning you've made payments on time with no late payments in the past year, and sometimes the home will need a new appraisal to confirm that it hasn't lost value. This is when a certified appraiser uses their experience and expertise to determine the value of your home. Just a note, even though Zillow says your home is worth X amount of dollars, doesn't mean it actually is. Only a certified appraiser can assess value, and that's the number your bank wants to see. If you qualify, the lender is required to remove PMI from your monthly payment. This can save you hundreds of dollars each month, years earlier than waiting for the automatic 22% cancellation. So if you're keeping an eye on your mortgage balance, don't just wait for PMI to drop off automatically. Ask for it as soon as you hit that 20% equity mark. Remember, this applies to conventional loans. With FHA, it's a lot tougher to remove PMI. Unless you put at least 10% down at the start, the insurance usually lasts the life of the loan. In that case, the only way to remove it is by refinancing into a conventional loan once you qualify. So how do you avoid PMI in the first place? You have a few options. The first is to put down 20%. This is the simplest option, but not always the most realistic one. But remember, even if you don't have stacks of cash or a hefty savings, down payment assistance programs can help. Be sure to look at what is being offered by your city, county, and lender. Sometimes this assistance is in the form of a grant, sometimes as a zero-interest loan. The details are too specific to get into in this video, but know that this is an option for many home buyers. Your second option is to apply for a VA loan. If you're a veteran or active duty military, VA loans don't require PMI at all. Of course, if you're not military, this isn't an option for you. You can also look into getting a USDA loan. USDA loans are for properties that are located in areas designated as rural by the Department of Agriculture. They don't have PMI either, though they do have their own insurance fee structure. The last option we'll discuss today is a piggyback loan. In some cases, you can combine a first and second mortgage to cover your down payment, though this isn't as common today. For many first-time buyers, the key is balancing how fast you want to buy with how much you can save. Sometimes paying PMI for a few years is worth it if it gets you into a home sooner. This is a very personal decision and one that requires you to think not only in the now, but also for the future. And remember, everybody has different financial situations and real estate goals. So just because a friend or family member has a certain type of loan doesn't mean that is what is best for you. So let's recap. PMI is insurance that protects the lender when you put less than 20% down. It usually adds $100 to $300 a month to your monthly mortgage payment. On conventional loans, it can eventually be removed. On FHA loans, it usually lasts for the life of the loan unless you refinance. And you can avoid PMI altogether by putting 20% down, using VA or USDA loans, or using other strategies. If this was helpful, hit subscribe so you don't miss the next video where we'll go over closing costs explained for first-time buyers. Because PMI isn't the only expense that can surprise you when buying a home. Closing costs are another big one, and knowing what to expect could save you thousands. I'll see you there.